Welcome, everybody. I'm Scott Hodge, President of the Tax Foundation. On behalf of our partners, H&R Block, and sponsor for today, I'd like to welcome all of you to another of the Tax Foundation's Talking Tax Reform series. Today our topic is the lessons learned from the Tax Cuts and Jobs Act. And I'm glad to see such a great crowd out this afternoon. I guess this is proof that the appeal of free pizza and a rousing discussion of tax policy overwhelms your fear of getting coronavirus from your neighbors. So, welcome. Well, today we have an all-star cast for our panel who will explore the unintended consequences of the Tax Cuts and Jobs Act and consider ways that we can avoid them in the future. Our all-star panel includes Kathy Pickering, Executive Director of the Institute, the Tax Institute at H&R Block. Kathy. Eric Toder on the far right. That's never happened before. Eric is Institute Fellow and Co-Director at the Urban Brookings Tax Policy Center. Kyle Pomeroy, also to my right, Resident Fellow at the American Enterprise Institute, and George Callis, who's a partner with Steptoe & Johnson, LLP, and former congressional staffer. Let me take a minute, if I could, just to set up today's panel. A very famous economist once said that there are no solutions, there are only trade-offs. Now, nowhere is that more of an issue than in tax policy, and certainly in tax reform. You know, over the last few years, my economists at the Tax Foundation have modeled hundreds of different tax policies and proposals. And we found that there are three or really four major trade-offs or considerations that you have to take into account in tax policy. The first, obviously, is revenue. And that's one of the things that's certainly a concern of this body. You know, will the plan generate more or less tax revenue? Or will it simply be revenue neutral? Big decisions with big implications. Equity, well, that's a question of who pays and how much. How much will the burden be shifted from one group to another? Will the change make the tax code more or less progressive? Those are big political decisions. Third is economic growth. Will the plan promote or dampen economic growth? How will it change incentives to work, save, and invest? Then the last is simplicity. Will the plan make the tax system more or less simple or more or less complex? Will the revised system be easier to comply with and easier to administer? Well, those are our four big ones. And what we learned from doing hundreds of simulations is, guess what? You can't have all of them at the same time. In fact, probably you can't even have three of those at the same time. What our model tends to show is that if you want more revenues and more progressivity in the code, chances are you're going to get less economic growth. And as we can all kind of imagine, when you have less economic growth, that tends to lead to less tax revenues. Now, on the other hand, if you want a simpler tax system, we get a lot of calls recently for a flat tax. What about a flat tax? We've modeled flat tax. You tend to have to give up a good deal of progressivity in the code with a flat tax, and you probably even have to give up some tax revenues as well. So those are some of the trade-offs that you have to think about when putting together a comprehensive tax reform plan. Well, these were the choices facing tax writers when they were crafting the Tax Cuts and Jobs Act. And we'll hear some of these themes in the comments from our panel this afternoon. From Kathy, we're going to hear about the taxpayer experience. Now, there's a phrase you don't hear very often in tax policy. We hear about the customer experience when it comes to retail or the tech world. You know, what's the customer experience with my iPhone? But no one talks about that in tax. And something tells me that the taxpayer experience is not so good right now, and that simplification may have been sacrificed at the altar of tax cuts and political trade-offs. From Eric, we'll take a different approach to the simplification issue. A look at tax expenditures. The Tax Policy Center has come out with a very interesting new study on this, and Eric is going to walk you through the results. And I think he may talk a little bit about some of the more philosophical underpinnings of the Tax Cuts and Jobs Act, and whether it achieved the goal of taxing all income at the same rate. Kyle will then move us into the economic realm with a look at investment response from the Tax Cuts and Jobs Act. Well, we hear a lot on TV about the sugar high from the Tax Cuts and Jobs Act. I think Kyle will clear up that issue and talk about some of the issues related to how international income is taxed as well under the TCJA, which then segues us into George's remarks. George, who I'm told wrote only the good parts of TCJA, will then he will then talk about the unintended consequences of the international provisions within the bill. He'll tell us what the tax writers were thinking when they wrote the international provisions. Now, it seems to me that there are two ways in which you can ask that question. What were you thinking when you designed that portion of the bill? Or you can say, what the hell were you thinking when you wrote that part of the bill? And we'll ask that of George. I do want to point out one last unintended consequence of TCJA, and it's a check that we got yesterday at the Tax Foundation from our good friends at the United States Treasury for $15.36. This is our overpayment from our 2018 Form 990T. And you ask, what is the 990T? This is the unrelated business tax on employee transit benefits that nonprofits like ours were then, and many of us like us, were unaware that we had to pay as a result of TCJA in order to make us equal with our folks in the business community. So instead of getting the $12,000 in overpayment that I thought, because they've now repealed this damn thing, we got $15 back. So anyway, that's my gripe. Now with that as the setup, Kathy, the floor is yours.
Thanks, Scott. And I'm really excited to be here today. So thanks for coming. And this is just such a great opportunity to talk about our favorite topic, taxes. As Scott mentioned, I am the head of the Tax Institute at H&R Block, and we provide the tax research support for the company. So we have a department of experts who provide guidance to our frontline tax preparers when they're writing returns and they need to, get questions answered. We'll provide that guidance. We also provide direct chat to clients as they're writing their returns when they need information. And what that lets us do is amass a lot of information about what kinds of questions taxpayers are asking throughout the season. So we get a really intimate view of the taxpayer experience and how people are navigating through the changes. Just to kind of set the context, TCJA was the largest change to the tax code in the last 30 years. We also saw the redesign of the Form 1040 and the consolidation of the 1040A and the 1040EZ. So a lot of changes going on there, all complemented with the longest government shutdown in history of 35 days right before the start of season. So we kind of had that perfect storm of a whole lot of things changing all at once. And when you ask, or when you look at how taxpayers judge the success of tax reform, they're looking at it through their lens, which is based on refund size, not tax liability, refund size, simplification, and predictability and control. So just to further underscore, H&R Block serves about 20 million taxpayers, and that's at the individual. So we serve all income spectrums, but we also serve about 2.5 million small businesses. So we really do have a front row seat into how's it going for taxpayers, how are they integrating these changes. Talking about now how they judge success and specifically on the aspect of refund size. When we aggregated the data and we looked at the national averages, we saw that on average, tax liability went down about 5.6% across the country. And that refund size stayed about flat or a little bit up. So you would say, yeah, liability was down, refund size flat to equal, people should have been happy. However, the experience was quite different, especially when you drill in and you look at specific localities. What was really interesting is, for example, in DC, we saw that the tax liability went up by about 4%, and refund size went down by about 8.5%. So if you were personally not feeling so good about your tax filing experience, that was one of the issues. Yeah. And we can go into more details about all the contributing factors there. Now, Kansas City is home to H&R Block headquarters, so it's also the home of the Super Bowl champions. And we, in Missouri, saw a decrease in tax liability of 8% and refund size up by 2.5%. So we were feeling pretty good about tax reform in general. Then, when you're talking about simplicity, when an actual taxpayer is going through their experience, it's different than how you would measure the numbers. One of the things that we looked at was, did we see a change in the number of people who itemized? And yes, of course we did. So before, it was roughly 70-30 split, itemizers, standard deduction to itemizers. And last year we saw that change to about 90-10. So a pretty significant decrease in the number of people who itemized their deductions. However, from an experience perspective, taxpayers still had to gather all their documents, calculate the return both ways to see which came out better for them. And in a number of cases, states still allowed itemizing at the state level. So you still had to carry all those documents and do all those calculations in order to be able to take advantage of it there. So they didn't really feel, the simplification in terms of the actual experience of preparing returns. We also then move into talking about predictability and control. And in there, as we're talking about the balance between tax refund size and tax liability, here's where the individual taxpayer really breaks down their understanding or breaks down in their understanding of this. So we know that if you want to have a bigger refund, you need to change your withholdings in general to have more withheld so you can get more later. But the way that the withholding tables were updated, the changes went in at the end of February in 2018. People started getting a little bit more in their paychecks at that point in time, but people don't see that, right? Most people get their paychecks direct deposit. They don't take that extra step to go and pull their pay stubs to see, okay, am I getting more money? Am I seeing it? Or for hourly workers, where they've got variable income on a week-to-week basis, it's hard to know, did I really see more money or not? And despite, a massive effort to try to get people to understand you need to update your withholdings in order to get the refund outcome that you want, what we saw was that consumers just don't understand, they didn't take action, and on average, less than 20% of taxpayers took any action at all to update their withholdings. So what we're seeing now is that for 2019, it was a full year of the new withholding tables. And so they're seeing an even bigger impact on their refund size. So if you didn't like what you got last year, you're not liking what you're getting this year either if you didn't take any action to change that. And ironically, we're seeing that one of the organic searches on our website is, why is my refund down? That search is up threefold this time of year. So kind of interesting year over year. People are still trying to get their heads wrapped around that. And then the other thing is on the 199A, the 20% pass-through deduction, the guidance came out so very late on that. It was really confusing, a lot of focus on, well, what's a specified service trader business and who's eligible to take this and how do the phase out calculations work. What we saw in general was that for our clients, they didn't even get near the threshold, so they didn't need to be worried about all of that, but it caused so much noise and confusion that I think that really deterred some people, especially in the early part of the season, from taking advantage of it. So I think we are seeing now more people comfortable with it, taking more advantage of it, and that's something we'll see unfolding over the next couple years. Kind of just to wrap up then, was it all negative? I know I've been a little bit negative about all of this, and what I would say is there were some things that taxpayers really did enjoy. The increase in the child tax credit, with the expanded eligibility, the increase in the size, people definitely took advantage of that, and they really appreciated it. The new other dependent credit was also one that people felt good about when they were able to take advantage of it. We definitely saw that, a lot of people did take the 199A, and I do expect we'll see more people taking that this year. And then also for the concerns about people that weren't able to itemize because of the cap on the state and local tax deduction, we also saw that on the other side, AMT was significantly reduced because of the increase in the exemption amount. People were able to save a lot of money if they had to have paid in AMT in prior, and it also totally simplified the experience because at least now they weren't calculating AMT. So I think that there were some things that on the individual taxpayer experience made it a very positive experience for those who were able to take advantage of those benefits. So with that, I'm going to turn it over to the rest of the panelists to judge, how the rest of the tax impact worked. But that was just a few of the comments on the overall taxpayer experience.
Thank you very much, Kathy. That was very interesting. I'll be interested to come back to the issue of the refunds. I remember my first job when I was filling out that, this was back in the dark ages, when the top rate was 70% and there were 24 brackets. And my boss said, whatever you do, don't over withhold, because that's like giving a free loan to the government. He did it because he said he was bad at savings. And so that was his way of saving. So yeah, people do misunderstand that concept quite a bit. Now we're going to turn it over to Eric, and who has a really interesting presentation on tax expenditures.
Okay, so I guess the topic is, did the TCJA make the tax law more neutral? And I'll preface that the rhetoric of tax reform was really to take the tax system out of private decisions, to make the tax law neutral so that people make decisions based on the economic benefits and the benefits to them rather than the tax consequences, and also to promote fairness among people who have equal incomes and to simplify. So that's the mantra of tax reform. A lot of that rhetoric surrounded the effort in the early 2000s by Chairman Camp and Chairman Baucus to develop a tax reform effort. So what in fact happened with TCJA, and did it achieve that? Well, there are a number of ways of looking at this, and I'll just present a little bit of data. One is what happened to total size of tax expenditures. I added them up, which you're not supposed to do because there are interactions among them, but we've actually done some estimates of TCJA, of the interactions, at least among the individual provisions, and they basically, when you take them into account, tax expenditures are only about 5% bigger than they would otherwise be. So it turns out that the net effect is not that big. These are based on Treasury numbers. They don't include payroll taxes. They only include corporate and individual income taxes, and they do include the outlay effects, which Treasury counts in footnotes. So if you look at this, there was a modest reduction of about a percentage of GDP in tax expenditures in 2019. It grows by 2025, but then it shrinks by 2027 as the individual income tax cuts expire. And if you compare that to Tax Reform Act of '86, that reduced, instead of 1%, reduced tax expenditures, I think, by around 3 or 4% of GDP. So it's a much smaller reduction. Well, what's behind those numbers? Just as usual, it's a few provisions that account for most of the effect. And the biggest one is the cap on the state and local income tax deduction of $10,000, which will reduce tax expenditures over 7 years by about $1 trillion in total. Now, that actually had wider effects than just on the state and local, because some of the other big ones, mortgage interest and charitable contribution, were also affected mostly by indirectly. Because mortgage interest, there was a change in the cap from $1 million to $750,000. That was only for new mortgages, and it doesn't affect that many people. So that's really a very small reason the mortgage interest costs less. The 3 other reasons: one is the increase in the standard deduction. The other one, a second one, was the cap on the state and local tax deduction, both of which meant that much fewer people are itemizing, as Kathy mentioned, and those who are itemizing get a much smaller benefit relative to the standard deduction. And finally, there's the lower marginal tax rates, which make deductions worth less to individuals. The only reason, that's the same reason the charitable deduction is on this slide. Actually, the healthcare one is the biggest tax expenditure, and percentage-wise, it didn't fall that much, but it's just a big absolute number because it started out very big, and that's wholly a result of lower marginal tax rates. The preferential treatment of active foreign source income is an interesting one. Actually, that is more than 100% a result of the decline in the corporate income tax rate. So the preference, as George will explain, was changed substantially from deferral to a minimum tax on foreign income. But that turned out to be a very big number, largely because of the lower corporate rate. When you look at the things that increased, the biggest increase was in the child credit, which was doubled, and they also added a credit for other dependents. That might be a little misleading. The tax system is not that much more favorable to people with kids than before because personal exemptions were eliminated. But that is not counted as a tax expenditure, so it's a little bit anomalous. The second thing is the deduction, 20% deduction for qualified business income. And the last is accelerated depreciation. That's mostly a timing. Its effect is really exaggerated by the cash flow numbers that are very large in the first few years and then turn negative, which is also a wrong answer. But overall, the acceleration of those deductions did provide a large benefit for business. And of course, those start to phase out after 2022. So that's a temporary provision also. So that's really what's going on with tax expenditures, a very mixed story. And let me just put one more slide up. And this is showing the maximum tax rate on various times of activity and how they were affected by both the Tax Reform Act of '86 and the 2017 Act. You could say 2 things about that. The 2017 Act really didn't narrow those disparities as the Tax Reform Act did. But what it did do, but you could also raise the question of whether the idea of narrowing those disparities is really that viable anyway. And I'll just make a preview. George will talk more about this, but I think what was driving a lot of what was going on in TCJA, particularly the business deduction that was driving this, was the cut in the corporate tax rate, which was done largely for international competitive reasons. But that created all kinds of other anomalies in the system. And if you look at the bottom 3 lines, if you look at Actually, 3 of the lines in 2018. The top rate on earnings is 40%. That includes the payroll tax and the 0.9% surcharge, the Medicare tax. The top rate on business income with a 20% deduction is 32%, and that also includes the payroll tax. I'm assuming that's earnings that's subject to payroll tax. And the tax on undistributed corporate profits, which is relevant because small companies have the ability to retain their earnings instead of distribute them, is only 21%. So what this does, two things. It creates a disparity between the treatment of earnings of people who are employees and the earnings of people who run businesses and have business income. So that's a substantial disparity. But at the same time, there's a disparity between getting business income from a flow-through and having a small corporation that's closely held that doesn't distribute. So how you make those things all work is very difficult. And I guess when I say the tax reform theory of '86 was maybe never viable in the first place, I would point out that there are certain kinds of income that will never be taxed. You're never going to tax the benefit that people get from household production, and you're never going to tax, probably never going to tax, much of the income they get from accrued but unrealized capital gains or from imputed rent from housing. And so that creates a lot of zero taxed income. And the question then is, where do we have preferences? We've always had a preference for realized capital gains, in part because we don't tax unrealized gains. And we have various measures like child independent care credit to try to even out the treatment of people who work in the home and people who take care of their own kids and people who go out and work and hire someone. So we're never going to get perfect neutrality. And the real challenge that we face in tax policy now is how to measure, how to manage all these margins. I haven't even given the justice to all the complexity that's out there. But I think looking forward, that's what we really have to figure out how to do. I'd make one other comment on behavior. From what I've heard anecdotally, not too much of has happened in regard to the benefit for C corporations relative to pass-throughs or pass-through income relative to earnings. I suspect that's because people realize, one, that these changes in the tax law are temporary, and two, that after the election, everything could change anyway. So I think it's a little hard to expect people to react as if these rates were permanent. I will stop now.
Thank you, Eric. This is a really fascinating chart, and if you allow us, we'd love to be able to share this with everyone that signed up today. If we can, we'll send that out to you, because these are some really interesting slides, and you may not be able to see them from the back. So thanks to the limitations here in the august Senate Finance Committee room. You can leave it up, that's fine. Yeah. Thank you very much, and we'll turn it over to Kyle.
Thanks, Scott. So I want to talk about what we've generally seen in terms of the economic effects of the Tax Cuts and Jobs Act. Now, no answer is going to be perfect on this, and I'll preface it with, I don't think we actually have a very good idea, but I do want to point to a few things that are interesting that both point in the direction that you'd expect, but also things that may point in the opposite direction. But before going into that, I'd like to actually just provide an overview of how to think about the economic effects of the Tax Cuts and Jobs Act, or tax policy in general. I think this is actually pretty important because the way that this is discussed often by some politicians, members of the media, may be a little misleading. But I think CBO does a very good job of describing what you'd call the three main effects of tax policy. So in the short run, a tax cut that could increase the budget deficit, that increases the amount of dollars in the economy chasing goods and services, increasing what's called aggregate demand. That can boost total output. Two, you have a long-run effect where tax cuts can change the incentive to work, save, and invest. This can increase the size of the labor force, the number of hours worked. It could also increase the stock of capital or productive tools that individuals use to produce goods and services. This all can increase output in the long run. And then there's a third effect, which is when you cut taxes and you leave spending the same, you increase borrowing, and this borrowing can have an effect on national savings. National savings, of course, finances productive investment in the United States, so you could potentially have a crowd-out effect. Great debate over the relative magnitude or importance of these three effects, but these are generally the three things you hear people talk about in terms of the effects of tax policy or the effects of the Tax Cuts and Jobs Act on the U.S. economy. Now, focusing on, I think, the incentive effects, because this is where I think a lot of the proponents of the Tax Cuts and Jobs Act like to focus, and the Trump administration. I actually think the incentive effects in the Tax Cuts and Jobs Act are somewhat complex. It's more than just, well, we reduced the statutory tax rate from 35% down to 21%, and that's it. The effective rate's lower across the board, and we'll get tons of new investment. There are actually places in which the Tax Cuts and Jobs Act increased the marginal effective tax rate on certain types of capital and reduced it on others. And part of that was, getting to this idea of reducing the difference between certain activities. But that's really important in understanding what the overall aggregate effect on output would be in the long run. And this actually matters both for individuals and businesses. So on the individual side, you focus on the reduction in the statutory tax rate as a reduction. But there are also things that may have slightly offset that. So we already talked about the cap on the state and local tax deduction. That actually is for taxpayers that were able to deduct at the margin, the state and local tax deduction, a reduction in their marginal tax rate on working. So capping that was a slight offset to the reduction in the statutory tax rate. On net, CBO and most modelers think that the tax burden on wages went down, but it's important to consider that it was more than just the statutory tax rate, and the effect may have been smaller than what those rate cuts suggested. Then on the business side, I talked about this, the corporate rate went down. We also had the introduction of the 20% deduction for pass-through business income, but that wasn't the only thing. Introduced expensing, but also introduced a cap on net interest expense deductibility. And the result of this is that certain types of investments faced an increase in marginal tax rate. Certain financing decisions increased. For example, debt finance investment, the effective tax rate is higher today than it was before the Tax Cuts and Jobs Act, due not just to the cap on the interest deduction, but also reducing the statutory tax rate itself increases the marginal tax rate on debt finance investment, because the implicit subsidy that existed under previous law is proportional to the statutory tax rate. And then other investment like business equipment, marginal tax rate for that went down. But another important component of investments in the United States, homeowner-occupied housing. Actually, not many people talk about this. The marginal effective tax rate on that type of investment went up, and this was due to the great scale back of itemized deductions, one of them being the deduction for home mortgage interest, which reduces the effective burden on that type of investment. So top line, looking at like the overall macro effect, under the hood is complicated, but top line, what did we expect? Well, just looking at the first couple of years, because this is what we have any sort of comparison for. So CBO said that economic growth would increase by about 0.3 of a percentage point in 2018 and 2019 due to the Tax Act. And that 0.3% includes both the demand side effect, but also the supply side effect, the effect on incentives. And then after that, the increased growth from the law would decline from about 0.1 of 1 percentage point going forward, and then gently drift to zero as a lot of these things started phasing, a lot of the tax cuts started phasing phasing out. They also specifically estimated investment, something that the administration and proponents are very think of it is very important here. They also estimated that that would go up as well. What happened overall, and I'll preface this again by saying, I don't think we can say all that much, but there are a few data points that I'd like to point to that are interesting nonetheless. And of course, this is no natural experiment here because we're running lots of different policy experiments at the same time that could offset one another, tax cuts, trade wars, et cetera. But 2018's growth, or overall GDP growth, was about 2.9%. And that's only 1/10 of 1 percentage point off from CBO's projection of 3% in 2018. 19, however, was another story in which economic growth actually slowed quite a bit and was much lower than CBO's projection. CBO had it at 2.8. We ultimately got 2.3%. And we can discuss what we think may have been going on there. And then under the hood for investment, a few things to point out. So equipment and structures, that investment was up in 2018. If you're just simply looking at the marginal effective tax rates, you'd say, okay, yep, that was expected. But with structures specifically, that was driven a lot by oil and natural gas and mining. You can kind of tell that this was the case because in 19, that type of investment cratered, and that brought structure investment down with it. Equipment was up in 2018, but then the growth was down. And overall, unfortunately, if you look at 18 and 19 together on average, compare it to what it was in 16 and 17, overall growth of investment is actually now slower than it was before the Tax Cuts and Jobs Act, which, again, a mixed bag result. And then the other piece I'd like to point out is that homeowner-occupied housing, the growth of that has slowed quite drastically since the passage of the Tax Cuts and Jobs Act, maybe more so than what you'd expect from the increase in the marginal effective tax rate on that investment, but it's still worth pointing out that relationship there exists. Just some final comments here going forward, just in terms of how to think about policy. If investment is something that's important here, investment is a forward-looking activity. And when you're thinking about forward-looking activity and the tax code, permanent is better than temporary. And to an extent, we think that investment might be suffering today. It could be due to uncertainty around what the future holds for the tax code. Just to pick an example out here, if you're, say, a pass-through business and you're looking to make an investment that's going to last 20 years, and you're looking at the tax code today, that may not necessarily be a good indicator of what you're going to be paying in tax 10 years from now, because if you're just looking at current law, the 20% deduction is going to phase out. So to the extent you thought that deduction was going to increase investment, it may not be doing as much work there because taxpayers are really not certain about what the future holds in that regard. And then last comment here is there are portions of the TCJA that I think they're going to either phase out that I think were good improvements to the tax law. I think that expensing overall is the direction we should be going, or just in general cash flow taxation of business income. That stuff is going to phase out. The treatment of research and development is going to worsen as the tax law switches to amortization. Those are things that lawmakers may want to look at and either cancel or reverse. Now, those things will reduce federal revenue. So if lawmakers in the future want a stable tax code, I think they also need to start looking at potentially other sources of revenue that can make our tax law sustainable. Because without that, you'll have lawmakers looking at key components of the TCJA, such as the lower corporate tax rate, as potential revenue raisers or things that need to offset the deficit that's growing. So that's, I think, something key to certainty as well. Thanks.
Thank you, Kyle. And last but not least, we'll turn it over to George.
Well, thank you. I usually love going last because it means I don't have to have my own material. I can just disagree with things my fellow panelists said. But they all did such a good job, I found very little to disagree with. So now, thanks for nothing, everybody. Now I'm stuck. Now I'm faced with the task of presenting in, 5 minutes? Roughly 5 hours of material. So I'll give it a shot. So focusing on the corporate and international, which they go together, corporate and international provisions of the TCJA. The way I put it, Scott was saying I was going to criticize or something like that. The way I put it is, when I think of it like a car, a model of a car over time, right? Every few years, you get a completely revamped model of the Ford Mustang or the Honda Accord or whatever. And all my life, I was always taught, never buy the first model year of a revamped car, because it always has all these bugs in it. Wait a couple of years as the bugs come out and you identify the bugs and they fix the bugs. And so by the second or third year of a revamped model. And I think, you don't, because of those bugs, you don't not revamp the model. We're happy to have 2020 Accords instead of 1978 Accords, 2020 Mustangs instead of 1980 Mustangs, unless you're a collector. But technology advances and you want those new versions, but they're gonna have bugs at first and you have to work them out. And over the long run, that's how you have major progress. I think of the TCJA very much like that. We needed a new corporate and international tax system. Let's not forget why we did it. As has been mentioned, we had an uncompetitive corporate rate. We had the highest corporate rate in the world when you include the average state rate on top of the federal rate. We have now gone from the highest corporate rate in the world to slightly worse than average. So we're still slightly higher than average. I think 21% plus roughly 5% average state corporate rate gives you 26. I think the OECD average is around 23-ish. So we're still a little above average, despite all the talk of windfalls and giveaways. But, given the United States' other advantages, if we're near average, we can compete. And that's where we are now. We can compete. We're not the highest in the world anymore. You don't have this wave of inversions of companies moving offshore. Like people forget this, right? The New York Times stories about the companies that are no longer moving offshore since 2017 are not written. They're just not written, but that is part of the story. So now we set about the work of trying to fix the bugs, right? We're happy to have this new system. We had to get it into place. We needed a more competitive corporate rate. We needed to move towards a territorial or a hybrid territorial system before we had all this trapped cash, trapped earnings overseas, because there was actually a U.S. tax on those earnings if you brought them back to the United States after earning them in your overseas affiliates. We got rid of that. It made trade-offs, Scott mentioned trade-offs at the very beginning, made trade-offs in the process, and we made a big move towards full expensing, at least for a few years and at least for equipment. And those were big positive economic, not only goals, but imperatives. And we achieved those and we had to make some trade-offs. Eric mentioned the rate differentials earlier. One of the problems when you bring the rate on U.S. corporations down to a rate that's competitive with foreign corporations, well, now the rate on U.S. pass-through businesses is uncompetitive with U.S. corporations. And so you need to cut rates for them too, and that's why we have Section 199 Cap A that is admittedly very complicated, but there's a very important competitiveness reason for that. When you go to full expensing, I'll mention some domestic provisions first because we can go down a big rabbit hole on international, which I'll get to. But when you go to full expensing, and I know some folks think this is less of a concern or more of a concern, but Congress decided it is a concern to go to full expensing, but still allow full interest deductibility, because then debt-financed capital investment could generate low or even negative effective tax rates and create its own distortion. So we created Section 163J, a limitation on interest deductibility to 30% of your adjusted taxable income. And I should say net interest expense. So if you have interest income, that offsets the interest expense. And then your net interest expense deduction is limited to 30% of your adjusted taxable income. Anything over that is considered over leverage and not deductible immediately. Big problem there at the end of big issue there at the end of 2021, the definition of adjusted taxable income, which is the denominator, changes to a much less favorable denominator, a smaller denominator. It changes from what we refer to as EBITDA, which is earnings before interest, taxes, depreciation, and amortization, to just EBIT, which is interest before earnings, or earnings before interest and taxes. The loss of the DA, depreciation and amortization, in the denominator means the more depreciation and amortization you have, which means the more capital expenditures, the more R&D, the more acquisitions you do. If you buy a patent, for example, the more of that stuff you have, the more deductions you have from that, the smaller your denominator, and therefore you have more interest disallowed. So after 2021, we have this formula that where economically productive pro-growth activities will cost you interest deductions, and that's a trade-off Congress made to get the new system in place, but delayed, just like R&D amortization, which will discourage innovative activities. They both change at the end of 2021. Congress delayed them for 4 years to basically give itself time to try to figure something out. And we're more than 2 years into that 4-year period now, and still, I think, in preliminary stages of conversations about figuring that stuff out. But those changes are coming, and they are anti-growth. So, those were trade-offs made to get the new system in place, and now we ought to take another look at them. I'll move on to the international side, where I could spend an hour, and I probably have 30 seconds. So moving to a territorial system where U.S. companies could bring their foreign earnings back without having to pay additional U.S. tax on it to encourage the repatriation of foreign earnings and reinvestment in the United States, very important policy goal. However, it creates a perverse incentive to shift profits overseas, because if you can earn your profits in Bermuda, pay zero there, and then bring them back tax-free, that's better than earning them here and paying 21%, much less 35%. So you need rules in place. We call them anti-profit shifting or anti-base erosion rules to guard against that when you move to a territorial system. That's where GILTI and FDII came from, global intangible low taxed income and foreign derived intangible income. That's where the BEAT, or the base erosion anti-abuse tax, came from. Those are new regimes that raise taxes on multinationals' activities and have a lot of bugs in them. In some ways, raise them more than was intended. The GILTI rate, so the way GILTI works, right, is the first, you get full territorial treatment on an amount of foreign earnings equal to 10% of your, call it QBI, qualified business asset investment, which is basically depreciable property. The idea there being, to the extent you're earning a normal 10% return on tangible depreciable assets, that's income that is not profit that has been shifted overseas. For tax reasons, that's income from real activity going on overseas because of the foreign markets overseas, because there are non-tax reasons to do things overseas. So that return gets full territorial treatment. You can bring it back tax-free. The excess return on top of that, which is kind of deemed to be a return from IP or intangibles that may or may not have been shifted overseas, is taxed at a reduced rate. That was intended, arguably, some people might argue with this, it was intended to be a reduced rate that ranges from 10.5% to 13.125%, depending on specifics, depending on foreign tax credits, et cetera, et cetera. I won't dive into the weeds on that. But the idea there is for excess returns, it's a hybrid system. It's part full U.S. taxation and part territorial, which when you blend together results in a reduced rate. I think most members of Congress who voted for it assumed that the maximum total rate you'd have to pay U.S. plus foreign on GILTI would be 13.125%. but because of the foreign tax credit rules, and specifically the foreign tax credit limitations, what we refer to as the expense allocation rules, which reduce the cap on foreign tax credits you can claim, you're seeing effective rates potentially much higher than that. In some cases, taxpayers were finding foreign or effective rates, U.S. plus foreign, on their foreign earnings well into the 20s, more than the full U.S. rate of 21%, which has to be the wrong result by definition when the intent was to partially tax those earnings. If they're paying more than the U.S. rate because of the disallowance of foreign tax credits, something unintended and wrong has happened. But there is, Treasury is writing regs on the high tax exception to GILTI, so foreign earnings subject to a foreign rate of tax greater than 90% of the U.S. rate, or 18.9%, would be exempt. There's a lot of details, devils in the details on that. I won't go into all those details, but that's the general idea. Some folks believe, well, okay, that's helpful. Now we're not being taxed at 25% overseas anymore, or 28%. 18.9 is the limit. But wasn't the intent 13 1/8? And it's 18.9 is still somewhat higher than 13 1/8. Well, I think Treasury feels they don't have the authority to go to 13 1/8, but I think from a legislative perspective, that is something to be looking at going forward. If we really want to make these regimes like GILTI and FDII work the way they're supposed to work, then we need to go back and say, okay, let's fix those bugs. Does that include a high tax exception at 13 1/8, so that you're exempt if you're over 13 1/8 on your foreign taxes? Does that include changing, modifying, or repealing the expense allocation rules that disallow foreign tax credits so that companies can actually get tax credits for all the foreign taxes they pay and not just a portion of the foreign taxes they pay? And I think these are things that Congress is going to want to be looking at going forward. Would we want to stop now or talk about the beat for an hour? Is this a good place to stop? Ask some questions? Okay.
Let's go to Q&A. And of course, the first question is, how many drinks did it take as you guys were sitting around coming up with the names GILTI, BEAT, and FDII? But we'll move on.
I'd like to answer that question, actually. On the names, the House receded to the Senate position.
Oh, they did? Okay. We'll always blame it on the Senate. And we say nothing ever happens in the Senate, huh? I do want to get to one issue, and please raise your hand if you have a question, because I want to get, this is your forum as well, and I want to get to your questions. But maybe touch on a little bit more, one of the biggest drivers of the trade-offs that had to be made in creating TCJA is the 10-year window, the Byrd Rule, and all of those things that limited and required a little bit of gamesmanship and sudden setting of some of the provisions. Perhaps we could touch a little bit on that, either from the incentive side, how taxpayers think about it, or some of the other implications that each of you might see from that, and how that it changes taxpayer behavior, the complexity of things, the decision-making, and so forth. And perhaps, Kathy, how do your taxpayers view this, and what are you seeing in that?
Great question. And from an individual taxpayer perspective, they just don't really understand, that there's an expiration date, things are going to phase out. And a perfect example of that is the recent passage of the extenders. So now we've seen that, the extenders got passed and it's retroactive. And so one of the things that was super interesting is with PMI. So people didn't get to claim that last year. And we did an analysis on it, and surprising to me, but that PMI amount was on average about $3,500. Would that have made the difference for some people to be then able to itemize or not? We don't know. We'll find that stuff out. But in terms of being able to have some sense of predictability and control and being able to plan your finances, individual taxpayers who aren't deep in following the policy are so much, they do feel out of control and unable to, know from one year to the next what is going to happen. So the fact that, things are going to expire over time is really not even a factor in the day-to-day average taxpayer's individual planning.
Yeah, I'll just say something from the perspective of those of us who worry about the national debt. I guess we're a diminishing breed these days, but I just looked at the CBO report that has debt rising to 98% of GDP by the end of the budget period in 2030. Of course, those figures assume that all the tax cuts that expire will expire on schedule. They also assume that provisions like R&E amortization and other, the ADIPTA provision that George mentioned, will actually go into effect as scheduled. And some of these are rather onerous. It's getting rid of, cutting back on interest deductions makes sense if you're going to go to expensing, but expensing is also being phased out. So when you look at forward, it really looks like many of these temporary tax changes will turn out to be permanent. And so the budget planning is really distorted. Things are a good deal worse than they look. The other thing is, you know, I lived through the 2010, 2012 experience when the Bush tax cuts were expiring and we had the fiscal cliff, and there was really no stomach. I mean, it looks like technically, relative to current law, there's no tax change, but if taxpayers are going to face big tax increases in this no tax change regime, that's how people are going to perceive it. So that's going to raise some interesting issues down the road.
Yeah, sure. So there's an old joke amongst tax professionals that 2/3 of the complexity in the tax code comes from the preferential treatment of capital gains. I don't know if that's true or not, but I feel like 2/3 of the complexity in the tax code comes from adherence to budget rules and scores that have what I refer to as the illusion of precision, because they go down to these numbers, they're not rounded or anything, but which are really just midpoints in a distribution of possible scores, right, and possible results. They're revenue estimates. They're not revenue commandments from Mount Sinai, and they're often wildly wrong. And we call it a $1.5 trillion piece of legislation. It's really $5.5 trillion in gross tax relief and $4 trillion in gross revenue raisers. And so the idea that it's going to come out even close, on either up or down to the estimates, with all the interactions going on, is silly. And yet we have expiration dates, we have phase-ins and phase-outs, we have income limitations, we also have all these rules and formulas and definitions and eligibility criteria that get layered in there to hit a very precise score. And each one of those things creates a lot more work for H&R Block and, you know, and so forth. And just creates a lot more complexity for taxpayers, even though the score really might not have a whole lot of meaning in the real world.
Yeah. Question.
Where would you look for money on this? Like, would be the idea to deficit finance? Are there other parts of the corporate code you would look to it? So I just wondered about that, because those do seem like big revenue time bombs that there's not a plan for.
Yeah, I'll comment on this first. So the good news with expensing, say you want to make that permanent or expand that to some degree, the obvious offset is to continue to go after net interest expense. So if your ultimate goal is to get to a cash flow tax, the good news is that the base of that tax is broader than the current corporate tax. So at the same rate, in the long run, you're raising more revenue. There is a transitional cost to that. But I commented earlier that I think, you know, if you're looking maybe at the individual provisions as well and everything else, and to make those sustainable, I think you do need to look outside of the Tax Cuts and Jobs Act for other sources of revenue, whether it's a VAT or what have you.
And the costs, though, are kind of illusional. The upfront costs are offset by the lower.
Well, it's a cash flow effect.
But I mean,
right?
of expensing.
Well, yeah, I mean, the government still incurs that cost. The revenue is lower in the years in which that, the provisions phase.
Well, you're still making a zero interest loan to
Yeah.
taxpayers.
Right,
So
right.
There is a permanent cost
Yes.
with the economy growing.
It is true that expensing, all three, expensing, R&D amortization, and then interest expense limitation are all timing differences, because the interest expense limitation is an unlimited carry forward. So it is likely true that in the long run, the cost is much less than what you might see in a 10-year budget window. There is a time value, clearly a time value cost to the government.
Cost.
Eric's right about that. I'm gonna sort of duck the question and say Congress is gonna have to negotiate that if Congress believes these things are enough of a priority to continue current policies, and I believe they are, there's going to have to be a discussion about whether and to the extent you offset that. Do you find offsets somewhere else? Do you not offset it? That is a conversation that is part of a negotiation that Congress will have to have based on priorities.
The downside of that conversation is that there's a really big bias in favor of just extending expensing on a temporary basis every single time going forward, because of the reversal of expensing makes it look really, really cheap. So that's a big risk there.
Anyone else? Well, how would you, looking forward, where would the major fixes be besides permanence? If you were looking at, maybe for the taxpayer experience, where would you look at issues that you could simplify that would make life easier on the taxpayer?
So one of the things, knowing that that taxpayers really judge the success of something based on the refund size, is reevaluating kind of the philosophy around the withholding tables, because right now, the way that those withholding tables work, it's really towards getting an accurate outcome. And there's I think that there's a lot of opportunity to make the filing experience simpler for taxpayers as their economic situation is changing.
Wow, we have a very quiet crowd here. Well, thank you very much. I appreciate it. I promised to get everybody out by 1 because I know that your times are valuable. But thank you all very much. We will share Eric's slides today, and please check back with us on Tax Foundation website. We're doing a lot of analysis of this as well. So please thank our panel, and we look forward to seeing you next time.